Adam Stern, CEO of Strata SFR, a boutique brokerage and consulting firm in the single-family rental space, focusing in on build-for-rent opportunities with regional builders, bringing build-for-rent opportunities to institutional investors and private equity funds. I've got a great guest with us today, Robert Dietz, the Chief Economist for the National Association of Home Builders. I wanted to invite a guest that could give us a good understanding and a good, well-rounded view of what the builder community is going through given the events of late with the COVID-19 pandemic. So if anyone can do a good job of giving us a 360 view of what builders are going through right now, it will be you, Robert. Thanks so much for being with us.
Absolutely. It's good.
Yep. So first question for you, just to frame the situation for our general audience, if you take a step back and you look at the general outlook of builders pre-COVID-19, like Q4 of this year, Q4 of last year, or early this year, how were builders looking at the housing market and the economy before the crisis, and how has that changed now that the pandemic is now several weeks into stay-at-home policies, social distancing policies, and the ensuing economic effects that that's had on the economy and the housing market?
I mean, it feels like more than a year ago, but 2020 was shaping up to be an excellent year for housing, for home construction. All segments we were expecting gains. So everything from high-end custom building to apartment construction. If anything, it seemed like a lot of economists at the beginning of the year were revising their forecasts up. We had historically low unemployment. We were expecting to see gains in townhouse, single-family rentals, the apartment industry. And of course, that's all changed in March. We're starting to see the leading edge of this wave of jobless claims. We've got about 16 million people that have now filed for unemployment insurance. We think the unemployment rate is probably going to easily get to about 13% on a temporary basis.
Right.
Given the strong start that housing had, the argument that we're making to policymakers, the Federal Reserve, Congress, and investors more generally is that housing will be one of those sectors that will help lead the economy out of what should be a fairly sharp recession in 2020. Right. So, we're watching the rental markets, we're watching the for sale markets. There's some issues with mortgage financing. But I think what we need really is some certainty with the virus. And I think that's going to come in the next 4 to 5 weeks. Right. Then we'll get some financial certainty, and with some policy help, the economy should start to rebound in the late third quarter, certainly by the fourth quarter of 2020.
Right. If you think back to 2008, the recession of 2008, the institutional SFR space was born out of the crisis and out of all the turmoil that ensued. Investors came in and ended up buying a huge amount of foreclosures from banks and turned them into rentals. They bought broken subdivisions from developers and builders. It created this kind of boom in this sector, creating a big opportunity for investors. I wonder if the same thing is going to happen for investors now with builders, because again, lots of building going on, more so than any other year. Builders are now breaking ground on certain projects, and because financing has changed, that's going to be putting some builders, to my mind, in tough positions. How can capital come in and kind of play that same role as it did in 2008 in the current economy?
Well, I think you need certainty, you need patience, because the next 2 months are going to be particularly rough, both for the virus data and the economic data. But let's take that 2009 experience as like an experiment. We know that the housing market, when it began to recover after the Great Recession, it was the rental market, it was the multifamily market that responded first. And why was that? Well, it was because incomes were lower. We had an elevated unemployment rate. And we know in housing models that in those kinds of environments, rental housing tends to do fairly well.
Right.
So I think our expectation would be for the fourth quarter of this year, going into 2021, we will see proportionally elevated demand for rental housing. Mm-hmm. And the reason that the single-family rental market is particularly well situated for that kind of environment is that we had, going into 2020, pretty good demographic headwinds for some of these older millennials that needed a single-family home.
Right.
We were starting to see, for example, gains in young adult household formation rates. We had about 8 years where the number of young adults who were living with their parents had gone up and up and up. And as we started 2020, that rate finally started to come down. But what does that mean? People are getting married, they're starting to have kids, and when they do that, they need more space.
Mhm.
So if they're not in an economic position to buy a home initially, say in 2021, they may seek out a rental single family structure in the marketplace.
Right. So the fundamentals of the what makes the single family rental market so interesting is because of that resistance to recovery or recession, I should say. If housing prices flatten out or dip, then the yields that investors might get increases because during that time the rental demand might stay strong. So looking at it from the builder's perspective, they were going into a really good spring market here. Now the spring market is looking not as good. The outlook's a little more bleak. So if they look at their retail exit opportunities versus, say, selling their developments to investors, is there really already, as of today, April 9th, been that shift from builders thinking, well, hey, I might as well just go down the rental route because I get out of the development, I get my money back in a short amount of time, I get to move the development, and I have to worry about the retail market maybe tanking this spring.
I think in the coming weeks, the real challenge is going to be on just completing the construction phases. So getting project approvals, getting engineering approvals. I've certainly heard discussions about, will we see an uptick in rental demand? So does that change the pipeline of some of these projects? But the single family rental space on the new construction side has traditionally been about 2 to 3% the single family starts. In
Right.
recent years, it was about 4%. I think it's probably going to grow to 5 or 6% over the
Mm.
next couple of years.
Yep.
And we're going to have to get through this period of time where we get a little bit of declines in people paying their rent on time, paying their mortgage on time. But some of these stimulus policies, these household level grants, should raise housing demand over the long run. And I think that'll be particularly true in the rental space.
Sure. So talk to me for a second about financing opportunities and financing facilities that builders have and the change in that market because when financing is easy, when it's readily available, it's easy for a builder to take that on and plan on selling these properties retail versus say partnering or selling their development to an investor. Has the change in the financing market started to change the behavior of the builders and their behavior toward investors specifically?
So I was looking at some data this morning that indicated about 60% of builders indicated that construction financing had gotten more difficult in recent weeks. So we're seeing both in terms of being able to get new loans, particularly from community banks, but also the ability to take draws on existing loans has tightened up. Now, some of
Right.
that's connected to issues beyond the virus. For example, there are a lot of community banks, local banks that are connected to energy development loans. And with the big drop in oil prices that we've seen over the last couple of months, a lot of those banks are sitting on some problematic loans, and that's going to make overall commercial real estate lending a little tighter. But generally speaking, when builders are looking out, say a year from now, they're going to be looking for financing right now in
Right.
terms of being able to try to make sure they're on the right side of an eventual rebound.
Right. Yeah. And let's not forget in 2008 and 2009, outside of the subprime mortgages, construction loans were one of the largest delinquencies that the economy and the finance sector experienced. And those restrictions and that governance had tightened up after the last recession. And so I guess my question is now, do you see a loosening of those restrictions to make financing more available for the builders given this crisis and the proliferation of it?
Maybe. So I think with respect to the financial institutions, they're going to have a lot of short-term concerns about opening up financing. The Federal Reserve is doing everything to make as much liquidity available for the financial institutions as possible. But generally speaking, if we're looking for things that would help loosen up that sector, it's really going to come from policy help, like from, for example, Fannie and Freddie maybe looking to create a secondary market for A, D, and C loans. That's a
Right.
ways off. That's more kind of theoretical, but that would be one way that we could see some real changes in the levels of credit that are available to builders and land developers.
Right, right. So, think about it. We work a lot with institutional funds, apartment funds, firms that were apartment funds, family offices, people that wanted to get into the SFR, single family rental sector, were almost chasing home builders before. And now that this change in the economy has happened, Um, what are the pain points of the builders and what they're going through, and what could be like a possible entry point for these new funds and these existing funds looking to pick up rental projects now that this change has happened?
Well, I think the initial pain point is going to be how many people are paying rent. That's sort of the kind of immediate concern. We've seen some scary numbers out there. I think some of them are actually overstated, but we'll watch the unemployment rate. But the underlying issue is really whether the credit can be available to builders to develop those lots, to develop
Right.
the structures. One of the things that we saw in 2008, 2009, and 2010 was the ability of builders to go and seek out alternative sources of financing. And
Right.
that rate had quadrupled or even quintupled as builders looked to bring on equity partners, for example, to replace lending that wasn't taking place from some of those community banks. So I
Right.
think we'll see kind of a similar experience as we go forward into the end of 2020 and early 2021.
Right. So if you think about strategies that funds might utilize to really speak to some of these issues that builders are thinking about, are there specific structures or are there specific strategies that an investor might look at? Here are the pain points that builders going through. Here's what they really need. Here's the value I can add in order to get more ingrained and create more opportunity to purchase and own rental properties over the long term.
Yeah, I think in the long run, you want to be looking at markets that have a lot of solid population growth. That's going to be areas in the South. It's going to be the mountain states. It's going to be also the traditional metro areas where it's difficult to buy a home. That
Right.
was one of the areas where we saw growth in single family rental was the idea of they wanted a single family structure, but they couldn't save up that down payment. And that's
Right.
particularly true in markets like outside New York, Boston, Washington, California, the kind of coast markets. Those markets are probably going to see a little bit of internal change in demand. I think we're going to see some growth for medium density environments at the expense of really high density environments, which
Right.
again suggests maybe a little bit of a decline for traditional tower type apartment demand and more demand for townhouses, single family space. So yeah, I think you got to look at the population growth of individual markets. Look for places that have concentrations of millennials. We're like
Hmm.
see an increase in the birth rates and those kinds of markets. They're going to be
Right.
looking for that 2,400 square foot house to replace the existing 1,000 square foot apartment.
Yeah, it should be interesting to see. There was a kind of a divergence of strategies that funds used early on in the last recession between just purely going after discount and chasing properties that might not have that large of a discount, but were in more fundamentally sound areas, right? So funds had built these big portfolios. Some funds built big portfolios wherever they could pick up that discount. Other ones really focused on specific geographies where they again had strong rental demand, good schools, low crime, low delinquency rates. It should be interesting to see how funds end up attacking this market, whether they go after strictly the projects that are really delinquent and in trouble, or if they're going to have an eye toward those fundamentals that are going to be good for them long term.
And you got to keep in mind the markets where home prices are going to continue to rise. We're probably likely to see a dip in home price growth, but some markets, I'm thinking of some of those mountain states where there's simply not enough supply to keep up with existing demand. Prices will continue to grow, both the rental price and the asset price of actual housing.
Right, right. So, looking forward, what ways will the economic impact of the epidemic continue to affect home builders even after the stay-at-home orders and the social distancing orders have been lifted? What ways will it actually impact the economy and also the housing market long term after COVID-19 has passed?
So we've discussed some of the financing challenges. I think we're also going to see some supply chain issues.
Mhm.
We've seen in our survey data the idea of lighting fixtures, plumbing fixtures, kitchen cabinets, other items necessary to actually complete construction. Those factors are going to be influenced because we've got to slow down global trade, we've got to slow down in manufacturing activity. So that will continue. The other thing, which is a little harder to measure, is I think with people spending a lot more time at home,
Hmm.
particularly working at home, people are going to begin thinking about their home differently. And that's going to have
Right.
an impact on design, on remodeling.
Yeah.
I'm speaking to you effectively from a room near my bedroom.
As am
Uh,
I. Right. Yeah.
yeah, And I think a lot of people are sort of experiencing that. And so the idea of, well, next time we do a remodeling project, do we want to upgrade the kitchen, or do we
Right.
want to add an addition where we have a dedicated office space because I might be working at home 2 days a week?
Right. Yep.
I think that kind of thing is going to happen more. And again, it suggests the kind of the demand between apartments and single family homes could change a little bit, because if you've got a single family structure, you've got more space and more flexibility.
Right, right. When you look at the two different products that generally my group of investors, the institutional group, goes after, it's detached single family homes and townhomes. Do you think there's going to be a difference in the way that those two product types fare in this environment, or are they more or less going to behave the same way?
Well, I should admit up front, I'm kind of a cheerleader for townhouse construction. I
So am
have
I.
for the last 3 or 4 years.
Right,
Townhouse construction makes up about 13, 14% of single family construction right now. I think that share is going to rise to about 20%, because I
right,
think if we're thinking about over the next 3, 4, 5 years, it's the medium density environments that are really kind of going to win out. The ability to have some walkability, but to have a front door. You're not in the central city, but you're not in the deep exurbs with a terrible commute. I think that's where the millennials, the younger Gen Xers, are going to increasingly have higher demand. So I think that's a particularly good market. And the other thing we know, we talked about how the housing and home can change. We've got a lot more delivery of commercial activity. So that is probably going
right.
to continue to accelerate the decline in things like shopping malls. And so some of the shopping malls will be turned into urban villages with single family homes, townhomes, and the like.
So just like anything else, crisis kind of breeds different changes in behavior, and you see that happening in the years to come. Sounds like.
Absolutely. I think the trends that were in place in, say, 2017 through 2019 will continue. We're just going to have to get through what will be an incredibly difficult 2-quarter period, and then make smart decisions by the time we get to the end of 2020.
Right, right. So tell me, and for people that don't really understand or know, what exactly does a chief economist for the National Association of Home Builders do? Like, what is your charge, and what is your focus day to day, week to week, month to month?
Yeah, that's a great question. So NAHB is a trade association. We've got 140,000 members, about 600 local chapters. I run the economics group. We have multiple groups within NAHB. We have a lobbying team, regulatory communications, that run the International Builders Show. But my group is a group of 12 economists. We do survey research. We've mentioned some of that data here in our conversation today. We have a macro team that does forecasting, watches all the housing and economic data. And then we have a policy research team that helps support our lobbying efforts on behalf of housing, real estate, and construction. So day to day, I do a lot of speaking to groups. The other half of my day, I do a lot of forecasting. It's a little bit of crystal ball kind of activity. It's gotten a lot
Sure.
here. It is more difficult in these environments, but it is a great industry to work for, because housing is so central to the U.S. economy as a whole. And
Yep.
earlier this week, we had a session with Chairman Powell at the Federal Reserve. So, the information that we collect from groups like yours in terms of talking back and forth, and then being able to turn that over to policymakers and the media, is really critical for the home building industry.
Do you and do you specifically interact a lot with home builders, regional home builders, national home builders? Is that part of the audience that you are most interacting with on a regular basis?
Absolutely. And in fact, sort of managing my team by long distance is sort of the usual for us. I would say,
Sure.
back in the normal days, I was doing 1 to 2 trips a week out to local markets, getting in front of groups of builders through our local associations, or through other trade associations, talking, listening, presenting our numbers, hearing their challenges back on our numbers, learning from them. So it's a really kind of interactive type environment. And it's a little different now. We're doing everything kind of virtually instead of through airplanes and trips. But it's a really rewarding experience as well, because when you speak to builders, they often will say and point to a location and say, I built that. This city
Right.
exists because of my efforts, my risk as an entrepreneur. Do well by doing good. So I think the industry is well positioned. That housing will be one of those sectors that will help lead the economy in the recovery.
And with that, Robert Dietz, Chief Economist for the National Association of Home Builders, I appreciate you being with me today. Thanks a lot for everything.